All right, I get asked this all the time, so let's settle one of the biggest debates in personal finance. Should you pay off your mortgage early or invest that extra cash into the stock market? Now, if you got a mortgage under 5%, I'm going to show you why paying it off might actually be the worst thing that you could do. But if your rate is around 6-7%, which is where mortgage rates in the US are currently at, it's a whole different game. I'm Seth Moran. I spent 20 years in finance, and this video is about the math, not the emotions. So if you want your money to work smarter, not just harder, click the subscribe button, kick back, and I'll keep it clear and simple so we can take that fear out of investing together.
You can't be serious.
So how do mortgages really work? Well, a 30-year mortgage is a bank's dream, not yours, okay? Let's say you borrowed $400K at 7%. Your monthly payment's gonna be around $2,660. Guess how much of that goes to interest in month one? Ready for this? $2,333. That's about 88% of your payment going just to the bank. Only $327 is actually going to be going to what you actually owe. Zoink scoop! Welcome to amortization. The bank front loads the interest and you barely chip away at the principal for the first 10 or 15 years. In fact, by year 20, you still owe over $229,000 on that $400,000 loan. So you've only paid off 43% of your principal. And if you hold that loan for 30 years, ready for this? You actually end up paying more in interest, $558,000, than what the original loan was for. So in total, you pay $958,000, so almost $1 million on a $400,000 loan. That's crazy, right? That's why paying down principal early can save you a ton, especially if you're saddled with a higher interest rate. But there's a better option in many cases. All right, so let's look at the stock market versus mortgage math. Let's look at the cold, hard numbers. The S&P has returned about 10.3% annually since 1957, right? Everyone likes to throw that number around. It's true, but after taxes and inflation, let's call it 7 to 8% real returns, okay? So here's the rule of thumb. If your mortgage is under 5%, investing will always be paying it down. If your mortgage is 6% or more, the decision gets a little bit trickier, and paying it off starts to make real financial sense. Why? Because making an extra mortgage payment is like getting a guaranteed risk-free return equal to your interest rate. Now, would you rather earn a guaranteed 6% or take your chances chasing 7 or 8% with market risk attached? Exactly. You'll take the 6% by paying it off. So the break-even math. So let's put some numbers to it. Now, if you have a $400,000 mortgage at 3% and you choose to invest $500 a month for 25 years at 8%, you'll end up with $473,726 in your investment account. But if you use that $500 a month to pay off your mortgage early, you'd only save around $188,000 in interest. Now that's a $285,000 gap. The math says invest, but only if your mortgage is below 5%. So here's your tipping point. This is how I'd look at it. If my mortgage is below 5%, I'm investing it. If my mortgage is above 6%, it's a strong case to start chipping away and paying it off. That 5 to 6% area, that's kind of the gray zone. So you got to run the numbers and see what's better for you financially and most importantly, your life situation. But there are intangibles and peace of mind here. So let's be real. Money isn't just math. Like for some people, peace of mind trumps ROI, return on investment. No mortgage equals no stress. No debt equals no monthly obligation. And in retirement, that's huge, right? So if you're someone who sleeps better at night knowing your house is paid off, do what feels right. Just know the math may not be on your side if your rate is below market levels. But this is important. Here's some tips to kill off your mortgage faster. Now, if you do want to pay it off early, here's 3 life hacks I want to share. Hack 1, BiWeekly Payments. I'm surprised that no one really understands this. Cut your monthly payment in half and pay that amount every 2 weeks because there are 26 bi-weekly periods in a year and you end up making 13 full payments for the year instead of just 12. So let's say your mortgage is $4,000 a month. So normally you'd pay $48,000 over the course of a year. So 12 times $4,000 payment, right? Now, but if you pay $2,000 every 2 weeks, that's 26 payments. And so 2 times 26 is $52,000. That's an extra full payment per year. The result is you can shave 4 to 6 years off your mortgage and save well over $100,000 in interest, especially on higher rate loans. Hack 2, add $100 to $200 a month. Even a small monthly boost towards your principal, not interest, okay, can save you years and tens of thousands of dollars. Hack 3, dump your bonuses or refunds or windfall from work, whatever it may be, tax refunds, throw it all at your principal. A $10,000 lump sum in year 3 can save $20,000 to $30,000 in interest longer term. Always call your lender and make sure these extra payments are going toward your principal, not future interest. You need to make sure you clarify that. So if your mortgage rate is under 4%, you basically got free money. So use that cash to build wealth, not just erase debt. Now, but if you're sitting on a 7% loan, it's time to run the numbers and maybe chip away at that principal. Let me know in the comments, are you investing or paying off the house? Smash that like and subscribe for more of this real talk. Thank you for watching my channel, Monster Capital. Remember, kindness is the rent we pay on earth, so do something nice for someone. See you in the next one.